All right, welcome back. This is the 12th episode in the Value of Growth lecture series. Today I'm going to take another stab at kind of the question of what attracts competition. We've set up this series by saying what we're trying to solve for is what I call the DCF challenge, the discounted cash flow challenge, the modeling of this growth. And we've used this chart now. This will be the third time, I think. Last time maybe, or just said this is what we're trying to do is find the value of a growing stream of cash flow or NOPAT or earnings or something like that. So I said, well, let's just slice the problem into two, a steady state, no growth NOPAT, and then the growth in the NOPAT. Let's create two different streams. And then I suggested if you want to model a steady state, no growth, NOPAT that lasts forever, it's actually fairly straightforward. The challenge is the growth. So I really want to separate growth. And I'm hoping, because this lecture series is called The Value of Growth, everybody realizes I'm leading up to trying to solve that problem of valuing growth. And that's where we're headed. I'm just spending a little bit more time on this blue area. Go back one, just that blue area, which is effectively earnings power, and no growth earnings power. And then the blue area, the value of that is earnings power value, which I've talked about in prior lectures. All right, so now I want to take all of this from a slightly different perspective. Last video, I did kind of the same thing and define this as earnings power. Earnings power value is effectively earnings power times duration. And for this to be true, we have to assume a duration of forever. And I know I get a lot of pushback on that forever part, but keep in mind that all valuation methods, whether it's PE, EBITDA multiple, favorite of the private equity world, or even a price to revenue, price to sales or something, is effectively a forecast. You're implying that the forecast is going to last forever. So I'm not asking you to do anything you're not already doing in a PE or EBITDA multiple or something like that. There is an implied assumption that there's some level of cash flow that's going to last forever. What I'm trying to do is make that more explicit. All right, so earnings power value is earnings power, which we often use NOPAT as our proxy, times duration. And to use the perpetuity valuation formula, we assume duration is forever. Again, I don't think that's a heroic. It sounds heroic when you hear it, but in fact, we do it every day in every other valuation method we use. All right, here was the challenge that I started to talk about a couple of lectures ago, and this is the one that I want to pursue. This question I want to pursue one more time, and that is, what if competitive pressures drive profits lower? We started this by asking the question is, will a positive NOPAT, a profitable company, attract competition? And what we saw right away is, no, it's really excess returns that attract competition, not the profits itself, because every investment every growth investment, you have to put in capital ahead of time. All right. However, if competitors are going to enter the market, drive down the profits, we can't use the perpetuity valuation formula, because that assumption is that there's a level of NOPAT, a level of cash flow, that's steady forever, no growth, but steady forever. And if that assumption is going to be challenged, then guess what? We can't use the perpetuity valuation formula. The nice part, though, is that if you can't get comfortable with earnings power value holding, you don't have to worry about growth. Because if competitors are going to enter the market, lower profitability, lower returns, then growth's not going to help the company. I'll spend much more time on that later, but I just want to focus on this. So, as I said last lecture, will a positive NOPAT attract competition? And no, it's excess returns, ROIC greater than your cost of capital, that's going to attract competition. Now, I want to look at this the exact same problem, the same three case studies we did last week. I just want to look at it from a slightly different angle. We're going to end up in the same spot. The answer will be the same, but just to give a different perspective, maybe some more insight. So here's our CEO. And in the last lecture, we pitched her 3 investment opportunities, which was craft beer, energy drink, or hard kombucha. all in the beverage market, just to keep it consistent. And what we showed is in the craft beer market, the implied return, 10%, equaled the corporation's cost of capital. So that was basically uninteresting. In the energy drink market, highly competitive, the problem is that the implied return was 8% against a 10% hurdle rate. That investment would actually destroy value. And then in the third, the hard kombucha, young market, there's opportunity for market share, you can reach scale. The forecast would be a 25% return on capital against a 10% cost of capital. So it's that third market that was attractive. That's going to attract competition. Now, I'm going to use the same case studies and ask a very similar question. But if you go and ask a CEO what their primary responsibility is, and you'll get lots of answers, but somewhere along the line, they'll say something along something close to my job is to create shareholder value. I'm not convinced they know what that means, but that's another topic for a later video. All right. So they say, I want to create shareholder value. In fact, I want to create the most value for shareholders. So what I'm going to do is run through these three investments using that lens. Which one creates shareholder value and which one creates the most shareholder value? The end result, the answer is not going to be any different than what we did in the other video where we looked at it as the potential return on capital. But I think this is kind of fun just to look at it again. All right, we're going to go look at craft beer. All right, in craft beer, the forecast, if you remember, was $10 million in NOPAT. And if I use a cost of capital of 10% and the perpetuity valuation formula, I will know that once this business reaches scale, it's generating $10 million. Let's argue that it will be at scale, no more growth in that factory. The factory's full. You're at full capacity. It would generate $10 million in NOPAT a year. We capitalize that at 10%. We then get the value of the investment at scale is $100 million. All right. Now, the problem is that you have to invest $100 million to enter this market, create the business. Hopefully you reach scale. Hopefully the 10 million in NOPAT is the right number. And at the end of which I have a business that is worth $100 million. I invested $100 million and it's worth $100 million. All right. So we now know that value created is equal to the value created will equal the invested capital when the ROIC equals the cost of capital. This is an important insight that we're going to use later in the lecture series when we start to talk about valuation more directly to real companies. So if a business only earns its cost of capital, ROIC equals the cost of capital, then the value of the business is invested capital. You can think of it as trading at book value. Book being, historical book value being a proxy for invested capital. Okay, great. And so invested value created minus invested capital equals zero. All right, so it's a value neutral investment opportunity. Completely consistent with when, in the prior lecture, when we were looking at returns. The potential return was 10%. The cost of capital was 10%. It didn't create any excess returns. We're now showing it doesn't create any value for shareholders. All right, important insight. All right, energy drink, the second opportunity. Now this one is less interesting, of course. Projected NOPAT is 8 million. The cost of capital is 10%. Capitalize the 8 million, we come up with a value of the investment of $80 million, which is terribly uninteresting because the invested capital to get into the energy drink business and generate that 8 million in NOPAT is going to cost you 100 million. All right, so in this case, the value created is less than the capital invested. So we now know that the value created is less than invested capital when ROIC is less than the cost of capital. Again, something we want to think about, put it in our toolkit for later when we're looking at really real companies. All right, so the value created minus invested capital equals a minus 20 million. Sorry for the screen typo. All right, so we destroy value by going into the energy drink market. All right, interesting. All right, hard kombucha. Now, obviously, we're going to get a more favorable result when we go into the hard kombucha market because we know that's potentially a much better business. All right, so the forecast here is NOPAT of 25 million. Cost of capital is 10 million. If the business were to reach 25 million in annual NOPAT no growth, annual NOPAT, 25 million, the value of that business would be $250 million. So that's a pretty interesting business. Okay, cool. And what you know is the value created is greater than the capital that you need to get into the business. So in this case, just like when we were looking at return, the return space is you're signaling to your competitors, hey, invest $100 million, create a business worth $250 million, creating shareholder value. And that, I think, is really the insight I wanted to deliver on this. So value created is going to be greater than invested capital when the ROIC is greater than the cost of capital, which is completely consistent with the prior lecture, right? And value created minus invested capital equals $150 million. So you're signaling to your competitors, hey, this is a really good business. You want to enter this business, you invest $100 million, reach scale, that would generate $25 million in NOPAT. That $25 million, if we capitalize it at 10% using a perpetuity valuation formula, no growth, right? We're not going to grow those cash flows. That's worth $250 million. But it only costs $100 million to get into that business. So as I said last video, and I'm going to say it again, we're setting ourselves up for a lecture on competitive advantage. And we're going to do a little bit more setting up the value of growth, which we'll do in the next couple of videos. But I wanted to come back to these three cases to really pound away at this idea that it's excess returns, the opportunity to create shareholder value that attracts competition. And we're going to use that lens when we go look at real businesses. All right, so this was value creation. So we look at the three businesses, we can stop and we say, hey, what we're signaling to competitors, potential competitors, is if we're in the craft beer business and the return on capital is only 10%, we're signaling to competitors, hey, don't enter this business. It's uninteresting. You invest $100 million, and maybe, just maybe, you'll create an asset based on cash flow value of $100 million, or in other words, it trades at the invested capital. And that's really an important insight. What is a business worth if it only earns its invested capital? It's worth its invested capital, right? If it only earns its cost of capital. So if a business only earns its cost of capital, it's only worth its invested capital. Energy drink, a worse business. You're only going to make $8 million. You have to invest $100. You're only going to make $8 million. You're going to have implied return on capital of 8%, less than your cost of capital. And if you capitalize those $8 million in cash flow, you're going to have a business worth $80 million, which is less than the original invested capital. So we now know, we knew it from last video, but we know it from this video as well, that if the implied return on capital is less than the cost of capital to make that investment, the ultimate business is going to destroy value, and it's not going to be worth, from a cash flow perspective, it's not going to be worth what you invested. So you're going to keep people away. The third business is obviously the other way, hard kombucha. We think, our estimate from our investing team or strategy team says, if we invest $100 million, we'll generate cash flow, NOPAT of $25 million, have an implied return on invested capital of 25%, significantly greater, nice margin of safety, in fact, versus your cost of capital of 10%. But the other way of thinking about it is if I capitalize that $25 million in NOPAT, I end up with a business worth $250 million, significantly greater than the $100 million I invested. All right, so with these videos, we've been able to set up a couple of things. One, we now have a sense of value that if a business only earns its cost of capital, it's only worth its invested capital. You can think of it as a potential entrance competitor saying, wow, if I invest $100 million, I'm going to end up with a business worth $100 million. Or if I invest $100 million, I'm going to end up with a business with a 10% return on capital. They end up being the same. Worse is I go into a market that maybe it's sexy, or I don't know, my shareholders are excited, but at the end of the day, this would be energy drink. At the end of the day, I invest $8 million, it's worth $80 million, but I invested $100 million, or I invest $100 million and earn an 8% return, less than my cost of capital. So either lens, whether I look at the value creation or the return space, I end up with a value destroying investment. Third one, hard kombucha, is just the other extreme, obviously. Invest $100 million, earn $25 million in NOPAT. That's a 25% implied return on invested capital, significantly higher than my cost of capital. Or I have 25 million, I capitalize that 25 million, and I end up with a business worth $250 million. All right, so if I'm thinking about my competitors, where they're going to be excited is if they believe they can earn excess returns, because they're either going to get a return greater than their cost of capital, or they're going to create shareholder value. Now, I said something a few minutes ago that said if the business can't hold that return on invested capital, there's no value to growth. And we can see right here the beginning of our insights. And that is, if you enter the craft beer market, you're not creating shareholder value. That growth is not going to create shareholder value. If you enter the energy drink market, that growth is actually going to destroy value. It's only markets like the hard kombucha where I can earn a higher incremental return that the growth is going to create shareholder value. So now we have our first kind of insight, our first rule of thumb is if the incremental investment can earn a return greater than the cost of capital, that growth will create value for shareholders. If that incremental return equals the cost of capital, I will grow but not create shareholder value. And in the energy drink market, I will grow and destroy value. All right, so I'm hoping we're now starting to build the base thinking about value of growth. All right, we just talked about that. Here's a chart to show you. In the first case, craft beer is value neutral. Energy drink is value destruction, and hard kombucha is value creation. All right, so at the end, if the ROIC equals the cost of capital, the value created equals invested capital. If ROIC is less than your cost of capital, the value created is less than the invested capital, the investment you made. And if your ROIC is greater than the cost of capital, then it's value creation, or you created value, because the value you create is greater than the invested capital. So it's that extra value driven by the excess return on invested capital that either creates value or attracts competition. Sort of all the same thing. All right, thank you very much.